Hello traders, Victor from Trade Pro Academy. Hope everyone is doing well today. And in today's video, what we're going to be doing is breaking down how I was able to use only $1,700 of capital to return 2 times the gain, meaning a $3,500 trade on the micro NASDAQ futures. I'm going to break down not only the trade, how I found it, where I was talking about it, right, with our friends at Trade Pro Academy, and the trade itself, right, recorded. The micro futures on equities have been around for maybe 4 or 5 years, depending on when you're watching this video, but they replicate the current E-mini future movement, which are the most liquid equity futures in the market that we have. So when these micro futures came out, we were exposed to the S&P 500 minis, we were exposed to the NASDAQ micros, we were exposed to the Dow micros, the Russell micros, all of these equity micros, which allow traders to enter the futures market at a much lower margin cost. So this allows more liquidity to actually enter the market as we got a boom of just general traders, even going from minis to micros and just new traders entering the futures market. So there's a plethora of liquidity in these assets. So for example, the S&P 500 E-mini, right? It's 50 times the index, meaning that one singular point on this futures contract is $50 gain or loss, right? This also requires about $400 worth of margin. Now, if you take the micro of the S&P 500, it's about 1/10 of the cost in all senses. It's 5 times the index, meaning you're exposing yourself to about 22,000, let's say, notional value in comparison to the 200K at the E-mini futures. It's also $5 per point of movement, right? Which means that one tick is only $1.25. And the margin, if you're using a discount broker, is $40 a contract. So you can control one contract with $40. Now, I don't necessarily recommend it, but it is an option. Now, you can look at this and say, okay, well, if I have $1,000, I can control multiple micro contracts, which allows you exposure to the futures market at a fractional cost, right? This is very enticing, especially with newer traders starting out. So this provides a lot of people of the opportunity to get into these futures markets, which one, are very highly leveraged, two, extremely liquid, and represent the opportunity for traders to get into an extremely liquid market and learn how these markets actually move, gaining the ability to trade them on a consistent basis. Now, naturally, micros, right, they're much better size. They can be a double-edged sword, realistically, because people can look at these and oversize aggressively, meaning that you can control a very large amount of contracts with a very small amount of money. They overtrade them, right, because they have access to liquidity and these very minute movements. So if you're not treating this as if they were minis, or you're not treating this very seriously, it can be very detrimental. Micros or minis, you can still lose a lot of money very quickly, realistically. When it comes to micros, right, I think it's an amazing stepping stone for people who are entering the live market conditions. I think that a lot of people even just enjoy their stay in micros and trade these predominantly. It's a very big misconception that a lot of people think that you can't actually make decent money trading the micros, right? Today, I'm going to show you guys an example of that where we had a $3,500 trade based on the NASDAQ micro futures, right? The risk was about maybe $1,000, $1,200 on this trade for over 2x the return. I was able to control this many contracts with a very small amount of money in the account, $1,700. However, the thing is, I don't think that people should max margin their accounts based on $100 margin. For example, if you have $2,000 in your account and the margin is $100 on the NASDAQ, I do not think you should be trading 20 NASDAQ micros. I think that you should be maybe trading 1 or 2. So I think that per every $1,000 to $1,500 in the micros, you should have one contract. So let's say you have a $5,000 account. Realistically, I think your max size should be around 5 contracts on the micros. This might sound counterintuitive because you're not max margining, but that's the whole point of risk management. I think these micro futures allow traders to grow their accounts fairly steadily and be able to bridge that gap between live trading and getting to the minis. I think that a lot of people should even just stay in the micros until their accounts grow to maybe 40, 50, even 60,000. I know a lot of people still consider 6-figure accounts for mini trading only. But today I'm going to prove to you guys as a testament that you can make good money only trading micros, and it's not necessary that you move into the minis, and you shouldn't rush to move into the minis, because one of the main aspects of the micros is that they allow you to actually trade and learn how to trade in a live environment with lower risk so that you can scale up more confidently, really build on your strategy, test your strategy out in a live environment, and really build that confidence as a trader. So enough of that babble. I want to show you guys how we took this trade, what it consists of, right? It's exactly what you've seen on this channel. Break down the trade, show you the trade, and what we'll have to do that is get behind a screen. So I'll see you guys at the monitor. All right, back at the screens here, and I'm going to be showing you guys what it is that got us in this trade, right? What are we looking at on this NASDAQ trade? And this is with NASDAQ Micro Futures. So again, it's a $3,500 profit using a very small amount of actual margin. Now, the whole point of this is I was looking at about 17 contracts as the full fill. I think I was going to go to 20 contracts total, which $100 per margin, 17 contracts, $1,700. Obviously, it is recommended that you have much more capital in your account than this, right? Realistically. So it's something that you do have to understand. Now, the premise of this, right? Why did I break this down? What was going on? Distribution theory. Distribution theory is using volume profiles and understanding where distribution blocks such as these and where large market ledges appear. And this is plastered all over our YouTube, all over our social media, everywhere on our website, right? Distribution theory is where we start to identify levels. Distribution theory, in this case, we're coming up into a very strong, massive ledge in the market. This very strong ledge at 15,200 or so. It tells us that at that area, there's strong-handed sellers that have appeared in prior sessions to stall prices from accepting volume above. When you have these large distribution ledges, when you have large distributions in general, the extremes, it's often seen as a very fadeable area where you can actually do a low risk market reversal to find a decent extension on the inflection. This is what I was looking at when I was looking at this, right? I was talking about this on Twitter, on Discord, whatever it is. So for example, here we have this broken down on Discord, right? For our members. What I was looking at was, let's open this up. What I was looking at here, you guys can see what I had written down is somewhere around the 15,185 to about 15,22. I understand it's a very large area, but realistically, these are massive regions that I'm going to be looking for potential shorts to taper off from that area, right? So if we look at this, these two white lines in between this box somewhere is an area where I'm going to start firing off the shorts and accumulate a larger position, right? And again, $2 risk per point. This allows me to be much more flexible with the entries. This is the beauty of NASDAQ Micro Futures. So you guys can see this is a huge area, right, that I'm starting to open up some of these shorts, average 15,195. So let's take a look at what this looks like. This was on June 14th somewhere. So why don't we dive into this hourly contract here? So here is the hourly on June 14th. You can see we peak up just above this area. The high is 216. So I'm trying to layer in around that area. And you can see even just that day, it dropped aggressively into 1480, right? So it dropped into 14,980. Very significant move of over 200 points. Now you can see once we actually accept back below this area, you get a much more significant drop, but that's not the trade that I was opening up. So if we drop down into the 5-minute, we'll see this a little better, right? Based on that distribution top ledge. When you first come into these large ledges, I do like to try the fade for the extension to the downside as an inflection point, because I think that these are pretty good initial shots to try that inflection point rather than waiting for all of these retest, all these potential turning points, right? All these confirmation things. When you run into it first time around, it's a very good chance that you have a low risk trade that can significantly reverse, right? So you can see right here, this is the 14th on a 10-minute chart. It only does last about a day or two, right? Even the next day doesn't really quite break the lows, but you guys can see over here, we come into it, nice wick, large downside. Yes, some news did help, but even on the next day, we hold it multiple times for a decent, still 200-point move to the downside. So this was a much larger one, maybe closer to 250. This one was about a 200-point move. So you can see here, it's all explained, right? 17 contracts on micros. NASDAQ targets are so on and so forth. Ultimate target 14,600. Obviously, we have to reach for some of the stars, and all of them but the last two were hit. So explaining everything, right? Leaving some stops on the last few, plus 15 points, blah, blah, getting in, getting out. All of it is broken down here. Even the addition for the next short into these areas. So what had happened in that region, right? Let's post the video somewhere on the screen so you guys can see how we're entering and how it's playing out. But realistically, I was capping my risk at about 40 points, which is $80 per contract, meaning the total risk on this trade was $1,300, $1,360 if you want to be precise. And I'm looking for something 2x realistically minimum. So I was targeting the following. You guys can see where these targets are realistically on Discord, right? I was posting it as we were looking for the downside. Taking 3 off at 15,115. You'll see it on the video as well as it continues to play, which is a gain of $480. Taking 2 off at 1560, which is a gain of $544. Taking 2 off at 1502, or sorry, 15020, $700. 1,500, $780, sorry, 14,975, 2 off at 880. And then the final 6, I had left 6 on for only $120 gain as it pulled back into that plus 15 target. So taking a total of $3,500 off the table. So this means even if I took all of, or even half of those 6 remaining, it could have been well over a $4,000 trade. So on the remaining 6, right, I got taken out at plus 10 or plus 15 trailing stop. I did this a few times that week at this level. You guys can see even the next day how well it holds. Barely peaking up top after a evening session run, right? When the market reopened, we were still hovering around the area where I did want to look for those shorts. And I did this a few more times. I think I did it twice more, yielding about $1,000 return. And then on the last try that I did attempt, I lost about $600-700. So again, these key areas, when they happen on these large distribution ledges, you can find the potential turning points. You don't want to underestimate the ability of micro futures, especially when you understand distribution theory very, very well. This, with a couple of $1,000 account, can really help you expand your understanding of how to trade futures on a longer perspective. And with market auction theory, can help you understand how to actually have bigger moves, look for bigger moves in the futures market. So if you want to learn more about that, more about distribution theory, again, it's plastered all over our YouTube channel. You can go and check out our free course at tradeproacademy.com. It's a banner. Go and click it. It's 100% free. That helps you understand distribution theory and also order flow. So this goes to show that using a very small account, you can still trade micros and generate very favorable profits. So I do like to trade micros once in a while, right? It's a good break and a reset from the minis, and it allows me to do things like these. So if you guys really truly enjoyed this video, drop a comment down below, hit that like button, hit that subscribe button, and we're going to go through multiple other videos like these, breaking down more trades as they come. So you can also check out our free course, which is in the bio itself, and I'll see you guys next time.